So we're going to talk about securities, blockchains, and everything in between. I'm going to invite my three guests to the panel, and I'm going to let them introduce themselves. So Maya Zehavi, co-founder and CEO of Ontiti. Eyal Hertzog, product at Bancor. And Carlos Domingo, co-founder and CEO of Securities, also the organizer of the event. So before we start, I'm going to give everyone like 90 seconds to introduce yourself, and please try to keep with relevant backgrounds to the topic at hand.
Hi, my name is Eyal Hertzog, and I'm a product architect and a co-founder at Bancor. Been in crypto since happy days of 2011, working on different models, mostly focused on user-generated self-service tokens and liquidity between tokens. Also, been 20 years entrepreneur in the internet space.
Hi, everybody. My name is Carlos Domingo. I started in the space around a year and a half ago. I founded a venture capital firm called Spice VC with two Israelis, with Ami Ben David and Tal Yashiv. And back then we had the idea of tokenizing the fund and issue a token against the economic interest of the fund. So it became very clear that this was a security and that you could not just sell it in an unregulated ICO as other people were doing. So we then hired a CTO to help us build the platform, Shai Finkelstein was here, and then once we developed the platform, a lot of people started asking us about the technology and decided to span it out and create this company called Securitize, which basically has technology to help people issue securities on the blockchain in a compliant way.
Hi, I'm Zehavi. I'm the CEO of, it's not working. Okay, of Ontiti. My background is in financial IT, and I spent several years in private equity before going full-time into crypto about 5 years ago, which was last bear markets almost. I joined up with the Coin Sciences. We had the first private blockchain platform, and then was VP product at Kedit, and doing Ontiti ever since.
Okay, so we're going to start with the first question. How many people here know what a security token is? Okay, that's a lot of you, so we'll skip that question. So I'm going to start by asking, let's say, the unpopular opinion. Why do I need security tokens when basically the securities ecosystem is completely centralized? That's the first question.
I think it's like asking why do we need an internet in a world where you have many centralized and separated network. We had many, I used BBSs, back in the days, but there's like CompuServe and AOL and many proprietary networks. At that time, we kind of figure out, hey, we can have a standard for a network, make network not a service, but an agreement between people, set of protocols. And those were implemented and supported. And we discovered that having a single standard that everyone can use, everyone can plug, that is not owned by any specific corporation, is very beneficial to our progress. So what we're doing here with security tokens is basically the same. We're saying there's so many thousand, I don't know how many different systems that do not talk to each other, that store those digital assets. And if we have a standard, which is what blockchain is a database implemented as a standard. It's a database which is a language that that computers communicate with each other, and out of that, a database that they can all trust emerges. So let's use that technology of decentralized, open, public database in order to create a single database that every asset in the world can use, and therefore everyone that builds a solution for that can support that standard. That will be very beneficial. You can move digital assets between institutions. That can be very beneficial. You can let everyone hold their own assets in a standard wallet that support the standard. That will be very beneficial. So I see so much benefits here that it begs the question, why is this question even asked?
So, I have a very good counter argument, but I'll let Carlos, take the answer first.
First, one thing is security tokens or issuing a security on the blockchain is just a different way of digitizing a security, which in many cases is already digital. Yeah. But as Eyal said, if you go back in history a little bit, until the 70s, securities were primarily traded in paper, and stock exchanges like New York Stock Exchange used to open only 4 days out of 5 because they needed 1 day to basically settle the trades, which means someone had to go with bicycles around Wall Street with paper certificates, moving them from broker to broker. And then obviously that whole system collapsed as people started investing more and more in stocks, and then they decided to digitize it, okay? And now the way they digitize it is what has created all the problems that we have today, and I'll give you an example in a minute. Because they decided to digitize it in a central way where, at least in the US, there's a single entity called DTCC, which is a central depository that actually holds all the shares from all publicly traded companies in the US. And then what people are actually trading is not the actual shares, but it's actually a certificate that gives them the rights into a certificate of someone else that gives them the rights into the certificate of the actual share that is there. So the problems that this causes is that first, settlement is not instant. So when you actually buy a share until it settles the trade, it usually takes days. The SEC recently, the last few years, they made a major achievement and moving from 3 days to 2 days. But within those 2 days, many things can happen. So there's counterparty risk, the price can change, the company can go bankrupt, they can be acquired, could do a big product announcement or very bad quarterly results, etc. So that creates a lot of risks. And when there's risk, there's intermediaries that manage that risk, which puts more cost into the system. Okay, and then the second thing that happens is the companies, they actually don't know who holds their shares. So if you're Facebook today, if you look at the annual report of Facebook, they report 2,500 shareholders. If a company is worth $600 billion, so obviously that's not true, right? The problem is they actually don't know who holds the shares, so they just record, Fidelity or E-Trade or someone that is the one doing the trades and have no visibility about how their shares are being traded, how they settle, who has them, if someone is shorting the stock, and things like that. So as Eyal said, and the problem of this is these are multiple databases that are completely distributed but not connected among them, and therefore this impossibility to reconcile all this data. So if all these securities are digitized in a database that is completely distributed, not owned by anyone, globally available, and then suddenly you actually settle instantly because when you actually move the digital share as a token from one wallet to another, you move the ownership as well, which is completely legal, at least in the US. Then suddenly you eliminate a lot of intermediaries, you have transparency in the system, you avoid issues of people hiding things happening with shares, you can conduct proxy votes because you know who the shareholders are, you can issue dividends without intermediaries, and lots of advantages. So I think that's why you need the digital securities.
So we have standardization, which is one thing. We have interoperability and process, digitalization, right? And what's your add-on?
So I would actually define it differently. So I think Eyal was talking about the networks, and Carlos was talking about the operational value of having no need for data reconciliation. I want to talk about the application of digitize as opposed to digitalize securities. From a company's perspective, and historically speaking, the securities that are publicly traded have been on the downside for the last 20 years. Actually, they've gone down 26%. There are less companies publicly traded in the US and the EU, and they are greater in size. The reasoning for that is less companies go public or look for funding from the public because of the cost of going public. That's one. And two is the different compliance requirements that are needed from any company that's public. So if you were to actually digitize the entire process of issuing securities, i.e. auditing, the issuance process in itself, and the full life cycle, end cycle, operational, treasury operation, and so forth, you would be able, just on issuance alone, to cut the cost by 30%. That means the amount of companies and the companies looking to raise funds don't have to be completely dependent on either, one, bank loans, or two, private investors. Now, if they go to a private investor, there's a liquidity premium, meaning you have to pay more in funding because you're giving someone a security that they can't trade. So it's going to be within their custody throughout the whole lifetime of that security. So putting securities and making them easy and applicable to issue securities, trade, list, and get the reporting and compliance done is something that can lower costs and have and help facilitate easier access to capital for more companies.
Okay, so to add that, basically everything you said, standardization, interoperability, digitalization, and digitization of the process and lowering the costs, everything is great, and I agree with all of it. But security tokens, basically they're a physical representation of your ownership of a security, a debt or an equity or a share or a revenue stream. Yeah, a digital representation. Yeah. Digital representation. And if I take us back to where blockchain started, which was Bitcoin, basically it was a decentralized, immutable, transparent, and censorship-resistant way of transferring value. So considering the fact that if I have Apple shares in my wallet and I lose the wallet keys, did I lose the shares? Probably not. Most people, as I know from Spice, if someone loses their keys, they're going to burn their tokens and they're going to issue new ones. So basically, why do I need a blockchain? Why do I need a token for that? I can digitize the entire process. Everyone knows that blockchain basically, correct me if I'm wrong, Eyal, is just a super slow database that gives up efficiency and other things because they want the decentralization and immutability and consensus. You can say no. I'll give you a question later, but that's basically blockchain. So how does that work with securities?
So the fact that you can implement a fully decentralized systems, which have no way to be centrally administered or controlled in any way, shape, or form, is one application of the blockchain. And Bitcoin is digital gold. However, when you're talking about a security by definition represents a centralized organization. So the security is essentially representing a share in some enterprise profit sharing or whatever it is. And that means that you don't have the same kind of problem that you have with Bitcoin, because when you lose the key for your Bitcoins, there's no one you can talk to. And that's the feature of Bitcoin. However,
exactly.
When we're talking about digital securities, that we want them to use a global standard and be transparent and being able to kind of transfer them between organizations or between different exchanges. So when you're talking about those, then those are in their essence centralized. There is an entity behind them, and all the examples of security tokens that I know, if you lose the key, the entity that issued the security token can say, "Oh, no problem. We will burn the
I forgot my password. Reset it for me."
It sounds like, they can move that, and obviously they shouldn't do that illegally because they're doing it to the eyes of the entire world watching. So it needs to be you that, kind of come there, identify yourself or in some way, and then we'll remove your securities to a new account. That's not a problem with security tokens. It's a problem with fully decentralized system, and security tokens are not trying to be that. Blockchain, decentralized database does not mean that you can only enjoy it for fully decentralized application. This is just one thing that you can build upon a decentralized database, which is Bitcoin, as a good example.
Why do I need decentralization?
Because that decentralization is a way for you to use the same standard, the same system to store assets, to manage the ownership, to move assets between places, to have the user account will be working on every different service provider because the user control its own authentication in that model.
IEEE invented standards way before blockchain.
Yeah, those standard was great. They just never implemented a decentralized database. The first standard to implement a decentralized database is blockchain, is Bitcoin as the first blockchain. And the only thing it did is running a single digital currency, which incidentally was the first thing we did on real database when we invented them. We just ran ledgers on banks, and this is why the CEO of IBM thought that you only need 5 computers around the world because, like Bitcoin maximalist, he didn't see any other use. And he was a smart guy, so it's not saying anything bad about Bitcoin maximalists. But there are more usage to blockchain, just like there were more uses for databases than we saw in the 50s and 60s.
Okay. Yeah.
So I don't think decentralization is where it's at. I think that's the strength of the network you're using as a database and the security properties of that decentralized network. Hold on. But the bare asset factor is something that people, I don't think, recognize. But bare asset securities, i.e. financial instruments, are actually illegal in most of the world other than some exotic, the British Virgin Islands, for example. So the concept of being the only one that has access to your keys without being able to have any key recovery services obviously doesn't hold for securities. However, if you look at the concept of a digital security, it brings forth something completely new and innovative, and that is the concept of having an editable security. And when you really think about equity or debt, you see that you have 3 functions in equity and 2 functions in debt, and you take them all in one paper bundle when you get that stock certificate, right? So if we're talking about equity, we're talking about fractional ownership, we're talking about governance votes, and we're talking about shares of revenue streams, i.e. dividends. When we're talking about debt, we're talking about payments owed, and we're talking about what happens in case of a default. Now, when you own one certificate, that is a legal obligation of what you're entitled to within that security. That's binding. So if you want to put up that stock certificates as collateral, you have to literally take that paper into a custody or trustee and show that to the bank in order to get a loan, for example, right? If it's a real estate deed or something like that. When a security becomes digitalized, that means that you yourself are able to transfer, say, the revenue stream for 10 years to the bank and say, hey, that's my collateral for you. And you can see the price of that according to what's going on in the stock market and reconcile that data. Now, the fact that you're using the network that is secured by a lot of other miners and is slow is minuscule in the grand scheme of things, because this is a new ability that is going to be able both for other issuers of bundles and ETFs to use, and for you as on a personal case in order to put up stock portfolios or sell different aspects and characteristics of that equity or debt.
So I think it all depends what type of definition you use for what a blockchain is. So I'll give you a different one than the one you said. So for me, a blockchain is a distributed database that solves the problem of how people that need to operate against the same data can actually do it without, having to agree on someone owning that central data, right? So from that particular perspective, the problems with securities precisely is that either they're not digitized, as Maya was saying, or if they're digitized in silos, and therefore, you could think of someone fixing the problem by building a central database where all this information will be there and everyone will agree and use it and write against that database. But the problem is that from a governance perspective, that's very difficult to make it happen. So a blockchain is just basically a way to say, okay, guys, we all need to work together. There's this problem, but Goldman Sachs don't want to connect your database to the one from JP Morgan. So just put all your data in this place, in this format, standardized, that everyone can use it. And by the way, you don't need to trust that when you move the share from here to there, it actually happens, because it will happen. That's the ability that the blockchain provides. And on top of that, you're absolutely right. There have to be some sort of central points of controlling, ownership, right? Because at the end of the day, you're putting an asset in digital form on a, decentralized database. And in the case of Spice, which I know quite well, we have put together a process internally to try to kind of like decentralize how we deal with someone that loses their keys, to make sure that people can actually trust us, that it's not just us printing shares for someone else. And then there's a lot of things we do, and involves also, a third party or auditors, lawyers that, will go validate that the guy has lost the keys, that the person is who says who is, and that the wallet, so the smart contract that can actually issue the shares is a multi-sig, so you need multiple people agreeing on triggering the transaction to issue more shares and things like that. So we're trying to kind of like add a little bit of decentralization to the process, which by nature is centralized.
You spoke a little bit about issuance of shares as as an entity that's not like the stock exchange or someone that does it. What kind of regulatory hurdles are you guys experiencing right now? Not just in the sense of someone trying to implement a new kind of technology that's basically revolutionizing the way securities has behaved in the last decade or century even, but more from a perspective as someone replacing an inherent part of the system, like exchanges, like Maya said, like clearing and settlement and a lot of other things. What kind of
difficulties and challenges do you see from a regulatory perspective right now on a global scale? Obviously, U.S. is, a different story.
So first, and I was discussing this with Maya a little bit. So when you talk about security tokens, I think the word token is terrible because it, makes people think about ICOs and utility tokens. It's basically a way to represent digitally a security, which in most countries, in particular in the US, is legal. And you just happen to represent it instead of in a central database like someone like Carta or Computer Shares will do today. You just do it on a decentralized ledger, which is publicly maintained, right? But from a law perspective, from a regulation perspective, you follow the same regulations that you will follow with a security. It's true that many of the regulations are not thought out for blockchain, and they will probably need to evolve to take into account advantages that blockchain brings, like eliminating a central depository or transfer agent or things like that, because you can do that on the blockchain. But for the time being, you just follow the existing security laws. And I think that the main problem is that especially when you do it in a global scale, is not just the SEC. You have to follow the security laws in every single country where there is an investor that buys that security. So as the issuer, you need to know, you're selling the security to this guy is actually allowed to buy it or not, and that's what makes it complicated, that you have to do research in multiple jurisdictions. And the second thing, especially in the US, is that the security laws are very convoluted, because there's the security law that says you can't do this, but then there's an exception that under this you can actually do it, and then there is, by the way, if you do something else, then you can have another exemption that you can do that, and not even the security lawyers, they actually understand what you can do on traditional securities. So forget about security token. And then you have the state laws, and then you have, the laws that the SEC doesn't care because they're from other regulations, but they tell you that you have to follow them, etc. So I think part of the problem is nothing to do with security tokens, is that the security laws were invented in the 30s, when the whole crash of the stock market happened in the US, because at that time there was zero regulation, and then a lot of people got scammed, like has happened recently on the blockchain space. And then they put some laws in the 30s, which have not been redone, but they have been amended over time. So and then this has created, a monster, regulation that is very hard to understand even for lawyers. And this lack of clarity is, I think, what the problem is. In other countries, it's a lot simpler, but the US is particularly convoluted.
So I think so far the regulators are not the bad guys in this story, meaning their doors are really open, and they have been publicly lauding the industry in itself to get together and form what's called SROs, self-regulatory organizations, and kind of figure out what our own standards are, and only within open discussions with regulators, and only then legislate that. So you see a lot of these different organizations coming up about within different crypto industries, one for exchanges, you have the GDF, the Global Digital Finance Group, you have another one for custody. That is one step we're taking, but you have to understand security laws don't just bind the issuance, right? I mean, 2 weeks ago, I was in the EU Parliament, I was talking to a guy who's in charge of financial markets from the EU Commission and one of the managing partners at the DTCC. And one of the questions, for example, they have is anyone who sells you a wallet for security, does that mean that he needs a custodian license? And if so, does he need one both in the EU and in the US and in Japan and in Korea and per every country? Because all that does is just build moats for startups looking to build in this space that might be something impossible to climb, right? And that leads us to the third part about regulation, which is maybe the existing intermediaries, the DTCC, the banks, the stock exchange, already have the inherent advantage in everything that has to do with security token issuers and infrastructure, right? They have the licenses, they have the money, they're pretty close to the regulators, even if crypto is starting to hire the ex-regulators at a very fast pace. So that's another question that we have to see, and I think right now, especially in the West, in the EU and the US, the regulators are open and willing to be patient and legislate only after we have innovated and kind of stretched out. As long as there is no fraud, investors are protected, and this is done in an open dialogue and discussion with them.
I'll give you another example of something I heard recently, which is similar to what Maya was saying about if you give wallets to people and they hold securities, they have to have a custodian license. The other day, a broker in New York, which ironically is involved in the security token space, he told me that we shouldn't be issuing security tokens on the Ethereum network, because when you actually transfer the token, the miners are the ones that kind of validate the transaction, and therefore they are transferring securities and they have to have broker dealers. And he's like saying, like, what the fuck is that? So it's like saying, Amazon, AWS, the Amazon Web Services, they need to have a broker-dealer license because NASDAQ runs the servers on top of it. So it's the same absurdity. So people need to understand that, the technology infrastructure has nothing to do with regulation. It's technology infrastructure for people to use it, and the people using it are the ones that need to make sure they have the right license depending on what they do or what they don't, but not regulate the technology infrastructure, because otherwise nothing will happen. And as Maya said, I think the banks and all these guys that have the advantage of this, they're trying to push, like DTCC, companies like that, trying to push these arguments so startups don't have a way to enter the markets and disrupt them.
Yeah, probably. So we have time for one last round before I do some Q&A with the audience. Everyone are talking about, not everyone, some people are talking about the value that security tokens can bring to startups and let's call it the entire private placement market as a mean of liquidity. Second markets and other kind of marketplaces or exchanges for equities or for real estate have been around for a while. They haven't really succeeded. Some can say because of the regulations or the complications. Why do you think security tokens would bring additional liquidity that didn't exist beforehand?
So I think, to your question, there is an experiment that will take place, obviously. I think the barriers in order to get yourself essentially liquid, to allow the public to own shares of what you're doing, of your business, so the barrier is dropping. Now, it used to be that, we were existing and running businesses before we had shares, right? So it used to be a time that people didn't have stock markets and no shares, and still there was, there was an economy and money and all of that, just no shares. And then, we got introduced to that, and we started to use that, and obviously derivatives and bonds and all kind of different securities that I think all of them, allow some greater participation. And in a way, I look at securities as a way to tap into the kind of collective consciousness for predicting the future, which is basically what you're doing when you're buying a share or a security. You're predicting that asset will appreciate more than other option that you have, which is an infinite number of options. So, probably at some point we will get to the level that, there would not be any more investors for that particular kind of asset. But you know what? A good example for that is actually a pretty recent one, is Kickstarter. So Kickstarter is a crowdfunding platform, and it obviously raising much smaller amounts and open to everyone. And no one knew what would be the demand for participation in Kickstarter project. And even today there's a new player, Patreon, that is doing like a subscription model. And there's quite a demand. Patreon just this year transferred $350 million to independent creators, just this year. So there is a demand. It's all forms of, you can call it crowdfunding, and on Kickstarter you cannot get any piece of the upside. You can just buy product. So what will be the demand for Kickstarter, where you can keep the upside and enjoy the success? Not like Oculus Rift, where the people who funded it got nothing. But if Oculus Rift would do it on a security token, I think it has potential. But I cannot.
I agree. But much like ICOs, STOs work with regulations. In order to invest in STOs, you need to be an accredited investor or exempt by one of the regulatory exemptions one of the regulators has. So you're basically not really expanding the liquidity pool. So what's different?
Okay, so let me answer your question in two stages. First is about not everyone needs liquidity. If you're a small startup doing a Series A, you probably don't need liquidity, and you probably are not going to enjoy the liquidity because you're too small and it's not going to be enough investors. So I think that the main problem is that the public markets, which used to be where people could actually participate, have been shut down and have been reducing. In the US, the number of publicly traded companies is half what it used to be pre-.com. And then the majority of the value has been generated on the private placement market. So the private placement market in 2017 in the US alone was $1.7 trillion. and there were 40,000 issuance, and publicly traded companies is like a very, very small fraction of that. And you said that this is only for accredited investors, therefore it doesn't democratize. That's actually not necessarily true. So accredited investors are also shut out from that particular market. Out of these 40,000 placement, there's only 300,000 investors in the US that participated, and there's 12 million people that are accredited investors. So there's a huge pool of people today which are completely left out from where money is being produced. And companies
Because
like Airbnb, Uber, etc., will be publicly traded already, 20 years ago.
They're out because why? Because they don't know of these
because
placements?
these private placements are done by, as the name indicates, privately. So only the VCs and only the high net worth individuals, family offices get access to these deals.
If I have like a $500 billion and I want to invest in startups, I can't?
Yes. If you have $500 billion, yes. But if you have $500,000, no. Because you will not even be in the circles where these deals are being moved. That's one thing. The other thing is about liquidity. You said, the secondary market for shares, let's say for Uber or Airbnb, already exists, right? You can go to Shares Post and you can buy them today, and it's extremely inefficient and it's more liquid than no liquidity, but it's not very liquid. And there's two reasons for that. One is that these are not global platforms to start with, which security tokens, running on a global platform like the blockchain could potentially be global. And the second one is that the complication of figuring out whether you can actually transfer or not the share is humongous. Like I was with the CEO of SharesPost Digital the other day. He told me that usually a trade takes 2 months, because in those 2 months, what they need to do is to figure out everyone that has participated in the Series A, Series B, Series C, who has right of first refusal, what type of agreements they sign, whether the guy wants, they need to reach out to them, etc. If you program this all in smart contracts and you put it on the blockchain, it's transparent and it's there and it's automated, you could do these trades in a compliant way instantly. And this is actually good for regulators, right? Because they'll be able to trace that the trade has been done in a compliant way. And this will definitely increase liquidity. The fact that it will have global exposure and it will, simplify the checking of the regulatory environment, because it's programmable ownership, what will bring liquidity as opposed to the existing secondary markets.
Okay, I thought I was going to be contrarian at the end, but I'm not so sure right now. So I don't believe that putting a security on a blockchain makes it liquid. So putting a token on a blockchain does not make an asset that represents liquid. What brings liquidity to a market is when you have a buyer and a seller agreeing on a price and settling toward, you said that. Hi?
You're sitting with Bancor on the same. You don't need a buyer and seller. That used to be the case until 18 months ago.
But then you have friction. Now, but what Bancor does is price discovery, right? And the way that you need to find out price on a security that is only traded in private markets or even secondary markets is very opaque. You don't have enough information. You don't have the reporting or the operating data needed to know how much you want to pay for that security. Is this on or off? Okay. And you need to find a way, and this is what I think digital securities brings to the table, is to be able to allow people a real price discovery based on the data of that company's operations. And that is not something that only representation of the ERC-20 will bring to that, right? Because things change in the life cycle of a company, their revenue streams, how much available capital they have, and so forth. Now, let's not forget that throughout the last 10 years, since the global financial crisis, we've been in the new normal of a very low interest inflating market with QE and governments pumping money in. That means that it was in the interest of all participants in the market, whether private or public, to expand, this is like the drama of this panel, the mic, to expand the valuations of companies. And if it used to be seed, stage A, stage B, stage C within startups, we now see what's called as stage F, or let's bring MBS and SoftBank into the round in the mega fund, right? And screw everyone else that could have maybe benefited from an IPO. Now, not having retail investors hold these investments is not a bad thing in my opinion. Why? Because you should have seen the people that lost a lot of money during the dot-com, and look at some people who bought into these ICOs and, I don't know, thought they weren't securities. And there is a lot of the people who are in the market today are passive investors, meaning they bought certain ETFs or funds that hold custody within a third party and bundled everything together in order just to give you the spread between what the market is pricing, the bundle of securities that are under that. Liquidity allows these companies to do that calculation with all the different intermediaries, right? Having these things happen on a ledger with the security tokens allow that process to be faster and bring in more of a return to the retail investor and their pension funds or 401k and so forth. It's not just being liquid, it's knowing how people are going to price and do the mark to market on securities that are not publicly priced. And that's what I think the real power of security tokens is.
So we have like time for like a couple of questions from the audience.
Yeah, hi. For those who don't know me, my name is David Benizri. I'm the CEO of River, so part of the space. It's a question for Maya. First of all, when Calistone, I don't know if you heard about them, they actually joined the blockchain network with Hyperledger, which means they're like the DTCC, but they are in Europe and they are using blockchain now. So my question is, what will happen to all these people that are trying to create the standard when a big player like Calistone is already creating it and already has this trust and this credibility?
So, having spoken to Euroclear and their project and the DTCC and the Calistones, I think you are overestimating the vapor and underestimating the standard. A lot of the time in these projects goes into reducing the frictions of complexities between their own data silos and different standards within them. So, for example, this I learned specifically about the DTC 2 weeks ago, is that after all the different designs, and they've been working on this for 5 years, before Hyperledger was even on the blackboard, before the team was even assembled for Hyperledger, or the name was bought from DAH, is that they are basically now only focusing on warehouse reporting. And even then, all they're doing is timestamping and notarizing all these transactions. They're still using all the old silos, right? So we haven't even gone to the point where we're talking about ISO standards or anything like that. It's more about where do we use the blockchain? What information are we trying to transact? What are we tokenizing? And we're still a long way from that. I think what is much more interesting in terms of the standard building is the Solomon coin that Clearmatics is doing with about 7 other banks, Barclays, Santander, Deutsche, UBS, BNY, and sorry? Santander. So that's where they're really working on the different standards of how the wallets and the interactions are happening for, and even though it's just cross-border remittance. But it's going to be an ongoing process.
Can you just say something about standards? Yeah. So I was working at the telco industry before, and some of my former colleagues are here. And the telcos were working for the last 20 years into the evolved SMS standard called RCS that will allow a lot of the things that WhatsApp does today, and it never happened. So I'm positive the same thing is going to happen because they're friends, but they're also competitors, and they're incumbents. They have not incentive into changing things, and they want to standardize things before they actually have built them. So I'm positive startups will actually disrupt the market, and DTCC in particular, or Goldstone, these guys, you actually don't need them. It's not about whether they use a blockchain or not. The role of a central depository disappears when you use the blockchain. So it's not whether they need to use blockchain or not. It's actually that role, it will be gone. So.
P2P from their model. That's the beauty of it.
So we have
I know.
We have time for one last question. Yeah.
Predictions for 2019. I hate to be a cliche. I'm sorry, but I am really curious. What are
Predictions from this industry, I'm sure.
Yes.
I have 2 predictions. One is that we're going to see 3 predictions. 100 security tokens, proper security tokens, actually issue on the blockchain. Today, there's hundreds of projects that haven't issued anything, and there's very few tokens, less than 10 that I'm aware of, that have actually been issued. So I think the number will multiply by 10. It's still small, but it will be more significant than now. My second prediction is that we will have 10 security token exchanges or marketplaces launch. So the promise of liquidity will start to appear, because this year there's only one that has launched. And the third one is that 80% of the startups in the security token space will disappear in 2019. Because, when I started a year ago, there were 3 companies, now there's 50. So, so
every building, every year,
yes.
80% of the startups.
No, but the boom that we have seen the last 6 months is just completely ridiculous, and there's no space for so many people, and not everyone will get funded, and all these guys will go away, and a lot of the noise that you see in the market will go away, hopefully.
My prediction, well, it's not entirely has to do with the security market, security token market, because I'm not that involved, but I do think that in 2019 we will see a decentralized application that is useful for the ordinary person, which is something that the blockchain have not shown us yet. I mean, there are applications very useful for black markets, and there's a application that are very very useful for fundraising and perhaps for security. But I predict an application which is useful for the end user, like the Google of blockchain, or I don't know, Hotmail or ICQ, or find the right reference, but something like that. I predict that will happen in 2019.
The first securities we're going to see in 2019 that is going to be a proliferation of crypto securities, but not security tokens. They're going to be fiat settled, uncensored money, like an ETF for Bitcoin. You're going to see futures for Ether and so forth. And Wall Street is going to be willing to embrace, trade, hedge, short, and engineer a lot of crypto-backed securities. Secondly, you're going to see the first wave of security tokens be real estate tokens, which is one of those things I think is going to be a colossal failure. And I will explain why. Because it's essentially every time you hear real estate tokens, you really mean a REIT fund. And REIT funds have outperformed the S&P in the last 8 years, 7% above it, given a very low inflationary mechanism. The minute they're going to raise interest, and this is historically for the last 120 years or so, REITs don't perform well. Why would you want to invest in a REIT? Just because it's on a blockchain. Now, security tokens are going to be tested not by crypto geeks like us, who like to really, or financial geeks, but based on whether or not it's a good investment. And that's where we're going to need to cut our chops. It means deal flow of who's going to be issuing on top of security token platforms, who's going to be trading, and what the returns and the whole life cycle of that security token is going to look like. And I think we've been much more focused on issuing and compliance just to get out the gate and not the rest of the life cycle. What happens if? How does voting happen? How do you report? What kind of compliance for secondary markets? Does it have to be on the same protocol? And we're going to be tested and battle weary by the end of 2019 on those issues.
I'm gonna sum up with I agree with everything all three of you said. All of them are very valid scenarios that we considered with relevant high probability to happen during 2019 and if not in 2020. I will just highlight something that Maya said about what we call crypto institutionalization. Again, we're seeing very high involvement of Wall Street, if it's banks or other types of financial institutions, hedge funds, getting into the space, investing a lot of money, putting their money where their mouth is, which is something that hasn't happened in the last few years. And I don't know if that is what will drive the next, everyone is waiting for the next bull run. So I'm not sure that's going to happen like in 2019. But it's definitely what's going to help change the trend we're seeing right now. Not going to discuss prices, but that's the way we see it. So with that note, we're pretty much out of time. So I want to thank you everyone for coming. We have, you can find anyone on LinkedIn or Twitter or whatever. You can send us questions or later after the panel. Thank you. Thank you. Oh, and thank you very much for Securitize for hosting this great event.